please. So what you see right up there is the assignment for next class, before next class, and that is to read chapter 2. We're at the easy stages right now. Chapter 2 gets into some more complexity that we're going to have on our midterm and our finals. So I'd advise you reading chapter 2, and it's going to be, for those of you who've had me for microeconomics, it's going to be very, very different than microeconomics, a different emphasis. So what I want to start today with is really what's going to be at the meat of the entire semester, and that is the mathematics and the concepts behind our macroeconomy. So some news came in today, and that is that our economy grew in the last quarter. I think it was 3.4 or 3.1%, which is really, really good news that the economy is not falling into a recession. And the reason why has to do with the formula that we're going to write down now. And so let's do this. So GDP. Everybody know what that stands for? We haven't read about it. What do you got, Connor? Yeah, gross domestic product. Would you write that somewhere down below? GDP is gross domestic product. Gross. Anybody have a job where you see a paycheck that says gross and net? You know what I'm talking about? Yeah. What does gross versus net mean? Yeah.
Gross is like before deductions.
Yeah. So here, gross is in total, everything. Domestic means where? So yeah, within this country, product means produce. So all the things that we make in this country is gross domestic product. And this is kind of the gauge that we have for how well we're doing, along with our unemployment rate and our inflation rate. And our unemployment rate is somewhere just above 3. I think it's 3.4%. And believe me, when we get into these details, I will know the exact rate at that time. I just know about where they are right now. So we've got GDP, which is made up of a few things. So the size of our economy is made up by how much C, or consumption, you and I partake in. So C stands for consumption. You could also say this is consumer spending. How are consumers feeling right now? Are they spending money? Or are they holding back on spending money? What's your feeling? So there has been a general reticence or hesitation to spend money because prices have been going up. But there's something called consumer sentiment that's gauged by a private institution called the Conference Board, and consumer sentiment is rising right now. And when consumers feel like the economy is getting better and better, what do? They start spending more. So consumption is quite robust. People are going back and spending more money. Now they're doing this even though there's some things that are headwinds that are coming up and stopping them from spending. And one is lowercase I, and the other is personal taxes. So write those, but put them in parentheses. Now, mathematically, this means something. It means that this consumption is a function of this, that this is a function of this. In other words, these things help determine what this is. And so these things, lowercase I, are interest rates. I don't imagine many of you, or maybe any of you, have taken out a loan yet and have to pay interest. Have you? Am I wrong? Yeah? What, on what? Yeah.
Car.
Maddie? Car? And a mortgage. Okay. So I'm going to get personal here, not too personal, everyone. When did you get your loan, your mortgage? June this year, 2023. Are you happy about your rate?
I got myself.
You did get. Can I ask what rate? This is a very personal question. What rate did you get? That is really good for right now, because as you know, what are rates right now?
7.
Yeah, so most people who don't get to get their own rate are paying 7 up to 8% for a home loan. Now, if you take out a loan for $250,000 at an 8% rate over 30 years, how much interest are you spending? Probably the entire amount, probably that $250,000 you borrowed, you're probably spending about $250,000 on interest that's going to the bank. Does that sound like something you want to dive into? What would you rather have, a high interest rate or a low interest rate? A low interest rate. So here, there's a negative relationship between interest rates and consumption, meaning that as interest rates go up, consumption will go down. We call that an inverse relationship. And our Federal Reserve Bank that manages our interest rates has been trying to slow our economy down by raising these interest rates. And so what's amazing right now is consumption is really robust, even though when you borrow money, you have to pay a huge amount of interest to a bank, and that generally makes people borrow less. People are still spending. So I think we're spending off our savings. Americans had a huge amount of savings after COVID. Why? Yeah, the stimmy, right? All the stimulus checks that a lot of people got. Businesses got a lot of money if they kept people on hand and paid them, even if they were shut down. So businesses and people have a lot of cash on hand, and we're spending that down, even though interest rates are high. Now, taxes. Bad subject, as I'm thinking about my tax bill this year, which is going to be a little bit higher. When tax rates go up, what happens to your spending? It goes down. So again, put a negative sign here. This is an inverse relationship. We'll talk more deeply about politics and different sides and what they believe in. But in general, if we have Republican Congress and a Republican president, what do they generally want to do with income taxes? Raise them or lower them? Lower them. Democrats have been accused, and rightly so sometimes, that they would tend to want to what? Taxes. Raise them. So let's assume Biden wins re-election and then the House and the Senate go Democrat. The worry among some people would be, since we have high debt, we might want to pay that off. And to pay that off means we would raise taxes, right? And what would happen to consumption in that case? It would go down, right? So for us personally, hopefully that's not going to happen. But think about if we have this debt that is so huge, one day we're going to have to pay it off. And that means maybe more of this. All right, next thing. The most important figure here is capital I. Capital I. Do I need to define personal taxes or taxes? Tax rates that you and I have to pay. Who pays most of the nation's taxes? The poor, the middle class, or the wealthy? The wealthy do. Those that make over what is it, 450,000? That's actually no, $550,000. They pay the bulk of the nation's taxes. What happens when you earn more money with personal taxes? You know what happens as you make more money? Yeah, what do you? Yeah, you work into higher tax brackets. The lowest amount that you can make, so under $10,000, you only have to pay 10% on that. But likely you don't pay anything if you only make 10,000. But as you make more and more money, that larger chunk. So as you get above $10,000, between $10,000 and I think $30,000, you then pay 10% on that money. And then once you make over $550,000, more or less, you pay 37 cents of every dollar you make. Over 37,000 or $550,000. So should that be that high? Should we, as you make more money, require you to pay a greater percentage of that higher amount? Is that quote unquote fair? Or should we charge everyone 37% on all the money they make? Is that fair? But get what I'm getting at here. Fair is in the eye of the beholder. Can you see how I can make an argument that it's fair that everyone pays 37%? Doesn't that sound fair in a certain sense? In a certain sense, that everyone pays the same. You get my point? Yeah. But is it fair if I make $20,000 a year and I'm barely scraping by and I pay 37%, whereas somebody who's making $1 million a year pays 37%? Is that fair? Yeah, and that's how our tax system judges fairness. They believe that as you make more money, more of that money should go back to everyone or to the government. How high was that at the highest point in our nation's history? In our nation's history, don't answer those who've taken me for U.S. economic history, but after World War I and World War II, We had tax rates at the top income bracket above $550,000, up to 91%. In 1950s and 60s, if you made $1 more than $550,000 in terms of income then, you paid 91 cents to the government. Is that fair? That depends on your politics, right? More liberal people will say, no, that's fair. You've earned a lot of money. You owe it back to everyone else to give more. On the conservative side, no, people who make a lot of money, they create the jobs. They need to keep that money so they can create jobs and not just send it off to the government. Now, one thing that's totally changed in understanding about taxation is it used to be Republicans and Democrats all agreed that after major wars, World War I or II, or major crises like the Great Depression, you raise taxes on the wealthy to pay off the debt, and then you lower those taxes again. During COVID, we spent a lot of money to get our economy through COVID. We went into huge debt. We'll talk more about debt later in the semester. What did we used to do to pay that debt off? Raise taxes on the wealthy. Are we going to do that now? No, and it's because when I said 91%, were some of you surprised? That people have completely changed their viewpoint around tax rates for the wealthy in bad economic times. We now feel like that's something that is inappropriate. You decide whether it is or not. We'll talk more about that concept as we move forward in the semester. Okay, now moving away from consumers and personal taxes, here capital I is business investment. I want you to add something here. This is going to be really important as we learn more and more complexities of macroeconomics. This is businesses borrowing money and investing in themselves. Would you write that down? Businesses borrowing money and investing in themselves. Is this you buying a stock? Is business investment people buying stocks? It is companies borrowing money and investing in themselves. So the answer is no. All right. So it's not that kind of investment. That kind of investment would fall more into consumption. Yeah. Yeah, exactly. Bonds, a company paying off its debt, its bonds, could be that investment spending. Indeed. Yeah. But an individual buying stock is not business investment. The way we see this is businesses borrowing money to go into themselves. And why it's super important is this is the gauge of how we're going to do in the future. Economists look at this figure and they see if in business investments going up, that means businesses are expanding factories. That means they're going to create more jobs. That means the economy is going to grow. But when we see this start to dip, it looks like businesses are contracting. That means they're going to have fewer jobs. That means we might be starting to slow down. Buybacks of stocks would be business investment. Great follow-up question. Same. Because that money is going back into themselves, right? But in general, I want you to know this. It's businesses borrowing money, investing in themselves, because as we get into some complexities around foreign exchange and exchange rates, you're going to need to have that differentiation. Now here, investment spending is a function of interest rates and what kind of taxes do you think? Yeah, business taxes. Do companies like high interest rates? No, they have the same relationship as consumers. As interest rates go up, investment goes down. What was the great worry during this last year? That because the Federal Reserve is raising interest rates to slow our economy down to get inflation under control, that businesses would stop investing in themselves and we'd fall into a recession. I made a bet with my last macroeconomics class of $1 to each student that we wouldn't fall into a recession, and I didn't have to pay. Should we make another bet? What should it be? Should it be that we fall into a recession? Should it be that unemployment? I think we should work on this, okay? Over the next couple of weeks, let's decide what to bet on, and I will guarantee you $1 if I'm wrong. Yeah. During the semester, yeah. And the problem for me is, like, if I was to say, I am certain right now we're not going to fall into a recession before the presidential election. Problem is, I've got to use what was a phrase in chapter 1, caritas paribus, or all other things equal. Like, given what I know now, all other things equal, we're not falling into a recession. And so it'll be a Biden, likely Trump reelection campaign with us not in recession, and that'll favor Biden. Now, what's happening in the Middle East right now? Israel's bombing Gaza and Lebanon. Iran bombed both Pakistan and Syria and Iraq. We bombed, man, it's going to take a while. We bombed Yemen, Iraq, Syria. Now, right now, the president's trying not to start a bigger war. And so there's some criticism as the Iranian, man, how deep am I going to go? Iran pulls it holds some strings of little puppet organizations, and it's trying to provoke us a little bit. And so there's some criticism that they've been lobbing missiles at our bases overseas, and some of our soldiers have been hurt, but none have died. But if they lob some missiles and they kill some of our service members, can Biden get away with doing nothing? No, he's gonna have to do something. And who's he gonna have to hit? If Iran launches a missile at one of their friends, Iran launches a missile and kills one of our boys or girls, we retaliate. And then what happens? Right? Then something big happens. Then what happens to oil prices? And then what happens to an economy? Goes down. So we will not fall into a recession, all other things equal. That's me covering my ass saying, unless we fall into a war, then all bets are off. And we still, so this is what I love about macroeconomics. You can talk about all kinds of things in the world that relate to us. So we also have North Korea that's threatening to actually invade South. They always talk, and now people are a little afraid they might actually do something. There's also more talk that China might take Taiwan. If that happens, yikes, then we've got major wars all over the world, and then our economy could do poorly. But now I'm going to contradict myself. So we fall into China finally tries to take the island that they think is part of their country, Taiwan. North Korea tries to take over what they believe is theirs, South Korea. Excuse me. Who knows what Putin might do next with Ukraine and the rest of Europe? But should that happen and we enter war, let's bring it back to this. What do you think G is? Government spending. If we fall into war, so let's write this down. Is war good for an economy in the short run when it's not taking place on your soil? Yes. We went through an economic boom during the Vietnam War. Why? Everyone's hired and you don't have a freaking choice, right? You're drafted. You're drafted and now you're employed. And then we spend all this money on weapons. So in fact, there's a kind of a perverse incentive here that if something really bad happens, then government spending would go up and we'd have to fight these wars. Okay. I sound like I'm schizophrenic sometimes because it's economics and there's all different sides to look at, meaning I kind of bounce back and forth between different views. If the government starts spending more money and we don't raise taxes, what does that mean we're going to have to do more of? Right, which means what? What do we have to do? If we're spending, what happens if you spend more money than you're taking in? Yeah, the deficit leads to national debt. So if that happens, we get a short-term bump in government spending, but we go further into debt. And economics, there's always two sides. There's never, this is good, and no matter what, it's always good. It's always, here's some good, and here's some bad. If you've taken microeconomics, you know about cost-benefit analysis. There's always costs and benefit to every action. Next. X. Sorry about that. Yeah, please remind me when I screw up there. X minus M is the international sector. If we were a country that didn't trade with others, which is known as a country in autarky, strange economic word that I'll never test you on, it means that you don't trade with other nations. Is there any nation on the planet that doesn't trade with other nations? North Korea illegally trades with other nations through China and Russia. So there is no nation on the planet that's in autarky. Go ahead.
I was just gonna say kind of North Korea, but not really.
Right. Like it's supposed to be because we're not, the world's not allowed to trade with them because of their bad behavior. But Russia and China have ships that'll meet their ships out at sea and they'll transfer oil. I'd say communist, not really Russia, but they're all dictatorships that want to take over neighbors' territory. So they're in the same kind of ugly club. So here, X minus M is X are our exports, M are our imports. Let's see if you remember something from last class, and this is a difficult question. If our dollar is weak, what does that mean for exports and imports? Talk to each other for a second. If our dollar is weak, meaning it's cheap to other countries, what happens to exports and imports? Talk to each other.
No, I think it's the vice versa. Because if our dollar's strong, it means it's worth it, we're starting to buy outside.
But it's weak, we're weak, we're weak.
We're gonna buy for like specific items. If it's strong, there's no one's gonna wanna buy our stuff.
Or it's at least more expensive.
Yeah.
All right, the dollar's weak. What does that mean it is to other countries? Cheaper or more expensive? It's cheaper, so it's cheaper to buy dollars. So the product price to them in their currency is lower, and that means exports would go up. Now, if the dollar's weak, it means that more of our currency is needed to buy foreign currencies. It means the price of their products are more expensive, and so we buy less of those. Is a weak dollar good for GDP? Well, look, more exports, so more on the positive side, less imports, less money leaving our country. And so this is from a, let's write this down, weak dollar. Donald Trump, when he ran against Biden, accused Biden and Obama, because Biden was Obama's vice president. He accused them of running bad policy because the dollar was weak. Was he correct? But doesn't it, if you don't know economics, doesn't it sound true? Right? They held a weak dollar. They're weak leaders because there's a weak dollar. Well, and by the way, I'll hit Biden. Okay, I'm going to go both sides because politicians lie because they want your vote, and they basically assume most people don't know their macroeconomics, and so they go on your gut instinct. And indeed, a weak dollar was great because it increased our exports and lessened our imports and helped us get out of the recession we had in 2008. All right. So by the way, those of you looking at me, why you're bashing my guy, I'll bash the other guy later on. All right. So this is what we call the demand side of our economy. The demand side is what's bought. You'll need to know this on our first test through the final. So the quicker we get this, the better. But that's only one side. That's what we buy. What am I leaving out? Yeah, what we sell or what we make. And so the other side is the supply side. The supply side is what's going to be introduced in chapter 2 in greater detail. What's needed to make anything? What do you need to make stuff or to provide us resources? So the first one is L, which is land, which is, let's do this down here. L is natural resources. I'm going to do this L1 because there's going to be another L. All right, so now I'll do a little economic bashing of Biden. When Trump was president, he opened up a number of places in Utah and Alaska for drilling for oil and natural gas. Did that help or hurt our economy? Did that make us able to make more things or fewer things? Make more things. Economically, was that a good decision? Okay, now, environmentally, with the methane they produce and the burning of that, where you stand on environmentalism, but was that necessarily good for the environment? No, right? Again, what am I saying about economics? There's always trade-offs there, right? So Biden comes in and he shuts that down. What does that do to our economy? Does that speed it up or slow it down? And slows it down. Is it the right decision in order to protect the environment? Raina says yes. Can I hear another answer? If we're not doing it, somebody else will do it, so we need to do it, right? What do we have? Different political beliefs, right? So hopefully both of you and everybody's heard each side, right? Okay, next. Well, what else do we need? So we got resources. Yeah, very good. So next one, let's do this L2, labor. L2. So this is human resources. All right. Apparently a lot of people are coming across our southern border. And those people want to work. And some states, not my home state of Texas, because we put them on planes and send them to other states. No comment. And then they go to New York State or Massachusetts, and Massachusetts and New York State process them and give them work permits. Is that good for our economy or bad for our economy? In terms of how much stuff can be made. That's good for our economy. Donald Trump wants to build a wall. Let's put aside whether a wall will work, because there are tunnels and people can climb over things. But if Donald Trump wins, assuming he's the nominee, and not only do we put in walls, but we put in electrified fences and force fields and I don't know what else, and there's no more immigration that's non-legal, what happens to our labor resources? Well, at least they don't increase, right? And maybe decrease a little bit. Is that good for our labor in terms, is that good for how much we can produce as a nation? No, not necessarily. Now, might you have an opinion that we need a border that's enforced? Anybody? So I spent 2 years in Europe. I was, as you know, I was a diplomat in Amsterdam, and I traveled all over Europe. Europe is what? Conservative or liberal in general? Very, very liberal. And what you think would be very, very open, man, you go across any border in Europe and they are strict, right? So one thing I like to tell my liberal friends, it's not liberal conservative about borders. There are countries that are very liberal that enforce their border. So you decide how much you feel we need to enforce it. But I'll tell you this, in terms of labor resources, what's our birth rate? Is there enough indigenous or domestic births to have a growing population in this country? No, zero. Last I looked, we have a 0% increase in indigenous population. If you have zero labor growth, what does that mean about growth of your economy? It's inhibited, right? And so what do you need to grow your economy? You need people. So here's where the debate happens between Republicans and Democrats about, okay, we need immigration. How do we do it? Right? Do we have a strong pathway to citizenship and open legal migration with some crackdown on illegal migration? But there's got to be a balance there, or else we have a stagnant economy. You don't have a growing population, you can't have a growing output of goods and services. Any questions or comments on all of that? Yeah, please.
On imports and exports, I wasn't really clear on how a stronger dollar to products made in the US being more expensive abroad.
Okay, so let's do this. Let's go down here. Strong dollar. Actually, let's leave a blank here. Let's do the opposite. So go back in your notes. Let's do down arrow here, up arrow here, and let's do strong dollar. And by the way, Joseph, we are going to go into this in enormous detail later. I'm just teasing some things here. So forgive my brevity. Strong dollar means our dollar. Oh, when should you go on vacation to a foreign country that uses a different currency? Strong dollar or weak dollar? Why? Because that country's on sale. Why? Because their currency is cheaper to us. Now, exchange rates are moving all of the time, up and down. And so, well, no, I'll stop there. We are at a point right now where our dollar is relatively strong. And I'll get into why it's relatively strong later. That strong dollar, I just saw a Facebook post from a old colleague of mine who's retired, who's in Argentina. How's he doing? He's living fat, because the US dollar goes a long way with the peso in Argentina, leaving out other details about Argentina right now. So when there's a strong dollar, your dollar can buy more of the foreign currency. The foreign currency is cheaper to you. So if the foreign currency is cheaper to you, that means their products are cheaper, and therefore your imports would go up. Because we tend to like to buy more things when things are cheaper. Now, on the other end, if our dollar is strong, it's more expensive to a foreigner. So if you want to come to the United States, I've actually noticed in the places I've traveled recently, there are fewer foreign tourists. Why? The dollar is relatively strong. If you have yen or euros and you want to buy a dollar, you now need more yen or euros to buy a dollar. Therefore, you're getting less of the dollar for your currency. That makes prices of our products more expensive, and our exports tend to go down. Does that help, Joseph?
So if you were selling a TV for $100 overseas, made in the United States, then that $100 would convert to more of the currency in that one country.
Exactly. Yeah, so the product price here is the same. The product price in a foreign country is the same. It's just the exchange for each other's currency changes the relative prices, given that you're using your own home currency. And again, we're going to come back to this in enormous detail because this is one of the most complex things that we'll learn.
What is the general?
Well, it's all relative. Is it increasing in value relative to other currencies? So let me see if I could. Versus the euro, I think, but let's why not look it up instead of make it up?
Is there a reason you look it up on Wall Street Journal and put anything else?
Yes, because in microeconomics, this dashboard right here of commodities is an example of prices of what kind of market. I'm looking at my ex-micro students. What kind of market are we talking about with these commodities? Very nice, perfect competition, I think I heard. So that's partially why. And I feel like this one has so much data that actually fluctuates, and they show you the fluctuations taking place. Okay, here's dollar and the euro, and this is just last day. But if we take this out to, oh, look at that, interesting for the 3-year. Right, which, I mean, that doesn't really say much because it's always relative. I mean, when I was living there, it was 1.5 euros for every dollar. So the dollar was not cheap from their perspective. But here, I don't know if I can tell a story that's. Yeah, let me tell you a story here. Let me get a good graphic up here and tell you, because I was gonna hold off from saying this, but your question makes me have to say what really moves our exchange rates. And it is, okay, so let's just do this. Okay, if you have money, so imagine yourself with $1 million, all right? Take that in. What are you gonna do with it? What are you gonna do with your $1 million? By the way, don't spend it, all right? You're young, put it away somewhere. What are you gonna put it away in? Real estate's not terrible, but are you going to put all your eggs in that real estate basket? Yeah. So if you're a sophisticated investor, where are you going to put some of your money? So in debt, right? Bonds or debt. Where else might you put some money? Bitcoin. Bitcoin. Let's have a talk later. What else? Gold, silver, stocks. Where would you put money in stocks? You got $1 million. Where are you going to put money in stocks? Like where? United States? Yes. So if you're a sophisticated investor, you're going to take your money, you're going to put it into all kinds of different accounts, right? Into stocks here, into different industries here, but also in different countries and different industries in different countries. But you're also, none of you said the word cash. Are you going to leave some of the money liquid and just put it in an interest-bearing savings account, one that's insured? There's all those other things you could lose the money. Now, if you're young, I get how you're shaking your head. Yeah, you want to take risk, right? But me at 55, looking at retirement, I don't want to have all my money in something risky. I want to put something in an interest-bearing savings account. So, United States interest rates right now are relatively high. If you have your money all over the world in a savings account in Germany, and Germany interest rates are 2%, and you can earn 8, I'm making that up. Say Germany is 2%, and you can earn 8% in the United States. My money, and I've got it in euro in Germany, what am I gonna do with some of my money?
Move to America.
I'm gonna move it to America. Now, to move my money from euros in Germany to a United States market, what do I need? Yeah, I need to exchange my dollars into change my euros into dollars. Whenever you do something like demand more of a product, whenever more and more people want something, what happens to the price of that thing? Price goes up. So when interest rates go up in a country, people demand more of that currency to earn those higher interest rates, and then that currency appreciates, okay? So here, what's happening is, this is changes between US interest rates and interest rates in Europe, right? And they've both been moving back and forth, and that's the larger trend over time. Earlier, we were increasing our interest rates, and so therefore people were demanding more of our currency and it was appreciating. But you can see there's some noise there. Now you see why I didn't want to get into this, right? Because it's variable rates between two countries. By the end of the semester, you're going to get this backwards and forwards. Oh, here's one thing. Do this. Write down trade weighted exchange rate. Trade weighted, that's hyphenated. That's going to be an answer on our midterm and on our final. Trade weighted exchange rate. I'm going to go down here in currencies to right here, the Wall Street dollar index. And then, keeps on doing that to me. I'm going to go out to 2 years or 3 years. Okay, what this is the exchange rate of our currency to all of our trading partners. So this is basically an average exchange rate. What's happened to the value of the dollar this past 3 years? Gone up. Why has it gone up? Because interest rates have gone up in this country. What are people doing with money that's overseas over the last 3 years? Taking it, exchanging it for dollars to earn those higher interest rates. So that's the story of what's taking place right there. If you know this, you remember this, and part of your business is involved in international trade, think about this. And here I'm getting a little ahead, but let's just play around. When we want to slow our economy down, we raise interest rates. You're running your business and inflation's ticking up, prices are ticking up, so you know that our government's going to raise interest rates. What do you know is going to happen to the dollar? What's going to happen to the dollar when interest rates go up? So it's going to become stronger. All right. The stronger dollar, and you make exports. How's that going to affect you? Negatively. Negatively, here it is. You're sitting there reading the paper and you see the data comes out, inflation starts to rear its head. It's starting to heat up. Then you know from this class, we're going to raise interest rates. Even the Fed hasn't even raised interest rates yet. You just read a headline and inflation keeps going up. You know interest rates are going to go up. What do you now know is going to happen? The dollar is going to get stronger. Now, what do you say to your production facilities about making your product as an export? Make more of it or less of it? You get that point right there? If you make less of it, if you had made more, would you be able to sell it? No, and that'd be a loss to you. Now let's look at the other side. Our economy starts having hiccups. Unemployment starts going up. We feel there's a recession on the horizon. You don't know this yet, but see if you can guess this. What are we going to do with interest rates to try to help the economy? Remember how consumption and investment are negatively related to interest rates? If the economy is struggling, what do we want to do with interest rates? Drop them, okay? We drop them. Or no, not yet. You read that the economy is struggling, unemployment's going up. You know from this class that interest rates are going to likely go down. Now, you know that the exchange rate is likely to become what? The dollar's going to become weaker. Okay, now what are you doing? You buy a lot of things from overseas. The dollar is now weaker. What does that mean about the price of those things you buy overseas?
more expensive.
So if the dollar is weaker, it takes more of your currency to buy the foreign currency. So those parts you need are gonna become more expensive in the future, most likely. What are you gonna do right now? We're falling into a recession, you've got enough parts for today, but not for the next year.
Finance, stuff here.
You might stock up, right? And let's not do arbitrage. You already got me on this one. We'll do that one later. So by knowing this, you can see into the future and save significant amounts of money by making those kinds of decisions. By the way, if some of that went over your head, it's fine. This is the second day of class. We're getting into complex subjects already. All right, continuing. The last thing, if you want to make something, you need natural resources, you need human resources. What else do you need? Yeah, you need, well, financing certainly, but you need financing probably for K, and K is capital. And let's write something down for that. K is physical capital. K is a machine that helps make other things. K is, let's write this down. Tools, tech, machinery. You need natural resources. You need people. You need machinery. Now, all of this, I didn't leave myself enough room here. All of this depends on, let's put a plus mark here, on how productive we make things. So P equals productivity. All right, I'm going to leave it right there because we've gone far enough into this, but questions? Yeah. So there's some books, including ours, that talk about entrepreneurship as a factor of production. That is land, labor, capital, and entrepreneurship. Entrepreneurship is people's desire and ability to come up with new ideas to start businesses. I think that's floating above this. The books that put it in there, I think are missing some nuance. They're trying to make something concrete that isn't very concrete. Does that make sense? Okay, so I leave it out. A lot of economists leave it out as well. Because it's assumed we're Americans, we're gonna have entrepreneurs. By the way, down here below supply side, below this formula, this is what's made. All right, a whole lot more of this as we move through the semester. Let's now, I want to quickly go through only part of the PowerPoint that I have for today, and then I want to get you in groups and answer some questions related to the reading. So.
Supply side, is that the equation or it's just a list of the guys?
No, it's an equation, so it is. And I'm realizing that I'm getting into stuff maybe I shouldn't be already. It is that land, labor, and capital, how much we have of it, and how productively we use our capital, labor, and land. So-
L1 and L2 say.
Now, let me do this. I'm gonna turn this over here. The way we'll write it is LLK P plus.
And that's
So-
L1, L2.
Yeah, L1, L2. Land, labor, capital, productivity is the supply side. Now, since you asked, let's do this. How do we make more things? By having more land, labor, and capital. So one just means more, opening up more places for drilling, allowing more immigration, companies buying more equipment. But then two is if P increases. I don't know if you know about fracking. You heard of the word fracking?
Yeah.
Fracking is getting natural gas out of places that we couldn't get natural gas out of before. Is fracking without controversy? It has controversy, right? Because it is taking water and chemicals at high pressure, pushing it into the ground to then get natural gas to come up. And the worry is that that high pressure water and chemicals can get into the water table. My understanding of the science is there are very few examples of it actually leaking into the water, underground water table that we drink. I know there are documentaries some teachers show of places in Pennsylvania where you can light the water on fire. Those are a little bit nonsense because there actually are places around the world where you turn on the tap and there's methane in the natural water that does catch fire. Now, what is the real problem with fracking, as scientists say? That when you use that chemical and water substance to go down underground to get the oil, the natural gas out, that some of it pools up on the top. And if you have water pooled up on the top and it drifts down to streams with fish and wildlife, that can be a problem. All of that said, that technology of fracking allowed us to get what? More natural gas. And so how did we get more natural gas? By being more productive, by coming up with a new technology that allowed us to get more natural gas. So if we have new productive techniques to increase our land resources, that supply side. Joseph, you hear me on that one? Because not just more, but how we're getting there. Now, you guys are in college. Why are you in college? To learn and hopefully become more productive, right? When you specialize and learn more about whatever it is you're studying, you're going to be a more efficient worker. So not only more workers help our economy, but more productive or efficient workers. And one way to get there is through education. Lastly, capital. Let's say AI, because everyone's using the term too much, in my opinion, but AI. Is that going to help people use their technology to be more efficient? I absolutely believe, I know doctors for sure are using AI. They punch in your symptoms and then they get a diagnosis and different forms of treatment so doctors can be more efficient in or productive in servicing people. In other words, higher productivity of the capital of the tech they're using allows them to supply more medical care. That helped, Joseph?
Yeah. So it seems like this is mostly like a correlation. So LLK, when those increase, the supply side increases when the supply side increases.
Absolutely.
It's kind of
And that would be a causation too, not just a correlation, that'd be causal.
a causal.
Yeah.
Okay. And then P is like a force multiplier on LLK.
Yeah. LLK or a function of P. Land and how productively we access those resources, labor and how productive those resources are, capital and how productively we use that capital. This capital right here that Wilford's using over there, was he, when he was just using it right there and early in class, was he being a more productive student? I'm going to disagree. And I know Wilford, I'm not just calling him out to be an asshole, but maybe a little bit. So sometimes, right back at you, buddy. So when we use this, are we always using it to be more productive?
No.
Says the guy who just got called out. But the point being is, it's technology that allows us to be more productive. Not all technology allows us to be more productive. This can, if we use it correctly. All right. Now, let's go to, I'm going to quickly, so as we go through this PowerPoint, don't write everything down. I'm going to tell you what I want you to write down. Yeah.
You mentioned trade weighted exchange rate.
Yeah. So what I said was that exchange rate was the one we were looking at, and it's the exchange rate of the US dollar to all of our trading partners. So it's essentially an average exchange rate of the US dollar to all countries we trade. Thanks for that